Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for July 2024. Well, sitting here at the start of Q3, this is traditionally the weakest quarter of the year for spot tanker rates. However, what we're seeing at the moment is a bit of a difference in behavior between the different tanker asset classes, with VLCC spot rates having declined in the last few weeks to their lowest point of the year. Whereas the mid-sized tankers, Aframax, Suezmaxes and LR2s, the rates in those sectors have remained quite buoyant. Now, looking at what's happening in the VLCC sector, first of all, what we've seen in the last few weeks is quite a large decline in crude oil exports from the Middle East Gulf. In fact, exports from the Middle East on VLCCs averaged just 12.5 million barrels a day in June, which is the lowest level we've seen since the first half of 2021. During the height of the pandemic. And it is typical to see Middle East crude oil export volumes go down in the summer because some of the countries there, particularly Saudi Arabia, keep more oil at home for domestic use for power generation, so there's less crude oil available for export in the summer months. And what's probably exacerbating that as well is the increase in refining capacity in the Middle East. So again, more of that crude is staying within the Middle East rather than being exported. So that decline in crude oil exports has really been impacting the Vs and explains why the rates there have been fairly weak. However, in the mid-size sectors, what we've seen is that rates have remained quite buoyant. In fact, it's quite remarkable to see how stable the Aframax and Suezmax rates have been since the start of the year, trading around the $40,000 per day mark, give or take a few $1,000s. And there are a few factors which are continuing to support rates in the mid-size sectors at the moment. So one of those is strong crude oil exports from key mid-size load regions, such as the US Gulf. We're also continuing to see the benefit to ton miles of vessels diverting away from the Red Sea and going around the Cape of Good Hope. And that's been particularly beneficial in the LR2 market. And what we've also seen in the last couple of months is the start of the TMX pipeline out of Vancouver. So that pipeline went live mid-May, and the first Aframax loaded there on May 20th. And just as a reminder, the TMX pipeline is a 550,000 barrel per day pipeline expansion to the port of Vancouver on the west coast of Canada. And the maximum size of ship that can load is an Aframax due to draft restrictions. So all of the volumes that have been lifted since mid-May have been on Aframaxes. And in June, exports from Vancouver averaged about 300,000 barrels per day. So the pipeline's up to about 60% of its capacity in the first month or two of operations. If we look at where those volumes are going, it's split between the US West Coast and Asia. However, if we look at exactly where those ships are going, most of those ships that are going on to Asia, most of the volumes which are going to Asia are being loaded from an Aframax onto a VLCC off the coast of California and then going on to Asia on the VLCC. There have only been 4 vessels done directly to Asia on an Aframax. So for the most part, the Aframaxes that are loading in Vancouver are transiting down to the US West Coast and to California and coming back again. However, I think it'll take a few weeks or months for the trade patterns to settle and for a clearer picture to emerge. But certainly it's creating more Aframax demand in the Asia Pacific region and should create even more demand as that pipeline ramps up over the next few weeks and months. So as I said, as we go into the rest of Q3, typically it is a slower part of the year. There are some factors there that are supporting mid-sized tanker rates, but I wouldn't be surprised if the rates do soften a little bit into August and September in particular. But looking ahead to later in the year, it looks like it could be another good winter market. We are expecting an increase in export volumes and cargoes as we go into the latter part of the year, particularly into Q4. The OPEC Plus group has announced that they're going to unwind 2.2 million barrels per day of voluntary production cuts over the course of a year, starting from October this year. So that should provide more volume in the back half of the year. And at the same time, we do think there's more growth to come from non-OPEC countries as well, particularly in the Americas, so the US, Canada, and Brazil in particular. So we should see more cargo supply going into the winter months, and we do expect another strong winter market. Now, looking a bit further ahead into the next couple of years, our outlook on supply and demand really hasn't changed. On the demand side, there is an expectation that global oil demand will grow by about 1.5 million barrels per day next year, and that we'll get about 3% growth on crude tanker ton miles. So not as strong growth as we've seen in the last couple of years, and that's because we're no longer seeing the post-pandemic rebound effect on oil demand, and trade patterns are a bit more settled as well. Nevertheless, it still represents a pretty solid level for oil demand growth and tanker demand growth. And that's particularly true if we compare it against the expected level of tanker fleet growth. Our outlook on fleet supply has not changed. Shipyards now are largely full through till mid-2027. So if we're looking out the next 2 or 3 years, the order book is pretty much set. And it's a manageable size of order book, particularly when you set it against the fleet of older vessels, which are going to be approaching age 20 and beyond, which are going to find it harder and harder to trade on. So our expectation is that tanker fleet growth will average about 1% per annum over the next 2 to 3 years, depending on the level of scrapping. Could be a bit higher if we don't see some of these older ships going for scrap. But nevertheless, it's still a low level of fleet growth compared to our tanker demand forecast. And so for that reason, we still remain confident that tanker spot rates are going to remain firm over the next 2 to 3 years. So that's our tanker market update for July, and we'll speak to you again next month.